The 2008 financial crisis, a house of cards built on dreams and debt. The year is 2008. The world watches in disbelief as the seemingly unshakable foundations of the global financial system crumble before their eyes. What began with the simple desire for home ownership morphed into a complex web of risky bets, hidden dangers, and ultimately, a devastating collapse that reverberated across the globe. It all started with a dream shared by millions: owning a home. It's a universal aspiration, a symbol of stability and prosperity, a place to build a future. And for a while, it seemed like this dream was within everyone's reach. Banks, flush with cash, were eager to lend money, even to those who had struggled with credit in the past. These were the now infamous subprime mortgages, offered with tantalizingly low initial rates that masked the danger lurking beneath the surface. Borrowers, enticed by the prospect of finally owning their piece of the American dream, often failed to grasp the long-term consequences of these adjustable rate loans. But why were banks so readily handing out these risky mortgages? The answer lies in the intricate world of financial engineering. Wall Street wizards had concocted a seemingly ingenious scheme, bundling these thousands of individual mortgages into complex packages known as mortgage-backed securities. These securities were then sliced and diced, repackaged, and sold to investors around the globe as safe and profitable investments. Ratings agencies, entrusted with assessing the risk of these investments, gave many of them their highest seal of approval, further fueling the frenzy. The demand for these securities was insatiable, driven by a global appetite for yield and a belief that housing prices would continue to rise indefinitely. After all, everyone needs a place to live, right? This booming market created a cascade effect. As demand for mortgage-backed securities soared, banks needed more mortgages to fuel the machine. This led to even looser lending standards and a willingness to overlook red flags in borrowers' credit histories. It was a classic case of irrational exuberance, a collective blindness to the warning signs flashing on the horizon. The party couldn't last forever. As housing prices peaked and began to decline in 2006, those once enticing adjustable rate mortgages started to reset, revealing their true cost. Monthly payments skyrocketed, and many homeowners, especially those with subprime loans, found themselves underwater, owing more on their mortgages than their homes were worth. Defaults began to rise, sending ripples through the meticulously constructed world of mortgage-backed securities. What was once considered a safe haven for investors quickly transformed into a minefield of toxic assets. The value of these securities plummeted as defaults mounted, leaving investors scrambling for the exits. Financial institutions, heavily invested in these now worthless assets, teetered on the brink of collapse. The first major tremor was felt in March 2008, when Bear Stearns, a venerable investment bank, was forced into a shotgun marriage with JP Chase to avert a complete meltdown. But this was just a prelude to the main event. September 2008 would forever be etched in the annals of financial history as the month the music stopped. On September 7th, Fannie Mae and Freddie Mac, the government-sponsored enterprises that underpinned the U.S. mortgage market, were placed under government conservatorship as their losses spiraled out of control. Then came the big one. Lehman Brothers, a 158-year-old investment banking giant, filed for bankruptcy on September 15th, sending shockwaves through the global financial system. The unthinkable had happened. One of Wall Street's titans had fallen. This was no longer a contained crisis. It was a full-blown panic. The intricate web of interconnectivity that had fueled the boom became a conduit for contagion. Banks, fearing further losses, stopped lending to each other, freezing credit markets worldwide. The stock market went into free fall, erasing trillions of dollars in wealth. Businesses shuttered, unemployment soared, and families lost their homes and livelihoods. Governments around the world, caught off guard by the speed and ferocity of the crisis, scrambled to contain the damage. The U.S. Congress hastily approved a $700 billion bailout package known as the Troubled Asset Relief Program, TARP, aimed at stabilizing the financial system by purchasing toxic assets from struggling banks. Central banks slashed interest rates and pumped trillions of dollars into the global economy to stimulate lending and prevent a complete collapse. These extraordinary measures, while controversial, ultimately prevented a repeat of the Great Depression. The financial system stabilized, albeit at a tremendous cost. The world had peered into the abyss and pulled back from the brink, but the scars of the crisis ran deep. The 2008 financial crisis exposed the flaws in a system built on excessive risk-taking, lax regulation, and a collective delusion of endless prosperity. It highlighted the interconnectedness of the global financial system, demonstrating how quickly localized problems could cascade into a global crisis. The crisis triggered a wave of financial reforms, including stricter regulations on banks, enhanced consumer protections, and greater transparency in financial markets. However, the debate continues about whether these reforms are sufficient to prevent a future crisis. The 2008 financial crisis serves as a cautionary tale, a reminder that unchecked greed and a disregard for risk can have devastating consequences. It underscores the need for vigilance, regulatory oversight, and a commitment to responsible lending practices. The dream of homeownership, a fundamental aspiration for individuals and families, should never be built on a foundation of sand. We must learn from the mistakes of the past to ensure a more stable and equitable financial future. If you found this exploration of the 2008 financial crisis informative and thought-provoking, please consider liking this podcast, sharing it with your friends, and subscribing for more insightful dives into historical and economic events that shape our world.